Inflation is soaring, surging to a new 40-year peak with rising rents, higher gas and food prices, making everyday life even more expensive. For more on this, we want to bring in Moody's Analytics chief economist, Mark Zandi. Mark, it's great to have you. That 9.1% print that we got this morning, I have to, think that this might have been a little bit hotter than what you were expecting. What's your takeaway from that report that we got?
UGG was pretty ugly. For the typical American family, they're now having to shell out almost $500 more a month to buy the same goods and services that they were purchasing a year ago because of the higher inflation. And just for context, the typical American family makes about $60K a year. So if you do the arithmetic, you get a pretty clear sense of the financial pain and suffering that's resulting. So yeah, a pretty ugly report.
And obviously, a lot of bringing up concerns about recession can usually consider those two consecutive quarters of falling GDP growth. But you said that this doesn't actually work for this current trend that we're in. Why is that?
Well, the 2 quarters of negative GDP, that's a rule of thumb, which has roughly worked historically. But the arbiter of recessions, at least here in the United States, is the Business Cycle Dating Committee, which is a group of academic economists of the National Bureau of Economic Research. And they look at a plethora of data. And GDP is on the list of things they look at, but it's probably down on the list. I think the thing that is most important is employment, jobs. And we saw last week that the economy created 400,000 jobs in the month of June and close to 500,000 jobs on a monthly basis over the past year. Unemployment is low. Layoffs are incredibly low. They may be record low. That's not consistent with a recession. The thing I just quickly say, and I won't go into any detail because probably everybody's eyes would glaze over, but I think there's all kinds of measurement issues, data problems, and ultimately, if you ask me back 5 years from now when we look at this data, I wouldn't be surprised if these declines got revised away.
Our eyes are not glazed over, sir. Do you think we're headed into a recession? Can the consumer stave it off?
Obviously recession risks are very high. With this kind of inflation and the Fed on the warpath and jacking up interest rates, recession risks are very, very uncomfortably high. Sentiment is very weak. I've never really seen anything like it. Consumers, business, investors, all very pessimistic. Seems like everyone's forecasting a recession, which is just unprecedented. You can see by my hairline, I've seen a lot of recessions over the years. I've never seen anything like it. Obviously risks are high. I will say, though, with a little bit of luck on the pandemic, let's just hope it continues to fade away, and a little luck on the Russian invasion. Let's just hope that the economic fallout the worst of the fallout is behind us. Then I think we should be able to navigate through. I think the Fed should be able to thread the needle and land. I'm going to mix all kinds of metaphors here, but land that economic plane on the tarmac without crashing it. And I think the American consumer, as you point out, is key to all this. They're the firewall between a economy that's growing and one that's in recession. And the firewall, it's definitely on fire. I mean, the high inflation is cutting into purchasing power. But if you look at excess saving and debt service and net worth, all the things you might look at to gauge the health of the American consumer, they look pretty good.
Mark, what about housing? Because we know that that's a very important sector when we talk about a recession, where exactly that falls. We've seen some cooling, at least in the latest data, when it comes to housing. But what are you expecting to see play out over the next couple of months there?
Well, that's going to weaken. Housing is the most interest rate sensitive sector of the economy. So the Fed is raising interest rates to slow growth, and that's going to work first and foremost through a weaker housing market. And it's already pretty clear that's happening. The higher mortgage rates were now just south of 6% on a 30-year fix. That's twice what it was, just a year ago when rates were at their record lows. You take that higher mortgage rate, you multiply by these high house prices, and people can't afford these homes. The monthly payment for typical first-time home buyers jumped by $500-600 a month. That's just prohibitive. So first-time buyers are locked out. Trade-up buyers, they're locked in, right? Because they have a mortgage sitting at 3.5, 4 because they refinanced down into those lower rates. Now, if they sell that home, buy another, and need another mortgage at 6, their mortgage payment's going to jump. So they're not going to do that. So home sales are already falling very rapidly, and the number of homes in inventory, they're starting to rise. So that means we will start to see some house price weakness. My sense is if we don't go into recession, nationwide house prices will effectively go flat here for the next 3 years. But that means big parts of the country are going to experience meaningful price declines, particularly it's going to be in those parts of the country that have seen the most significant increase in price, because like Southeast, Florida and Atlanta, Charlotte, and in the Mountain West, Boise, just learned how to pronounce Boise down to Phoenix. Those prices have jumped a lot. And you mix in those higher rates, affordability becomes a real problem. And that's where we're going to see, the most significant weakness. If we go into recession, then nationwide, I expect to see some price declines.
So then in terms of signals ahead, keeping an eye on what's been happening with the treasury yield curve there, what is that signaling to you right now?
Yeah, that makes me nervous. I had been hanging on the yield curve 10-year, 2 years as evidence that the economy can navigate through. Now, it's only been, I think, 4 or 5 trading days that the curve is inverted, meaning 2-year treasury yields have risen above 10. And today, obviously, it inverted meaningfully. I think the difference today is about 20 basis points or 0.2 of a percentage point. That's consequential. So if the yield curve stays inverted like that for another 2, 3, 4 weeks, then I may have to give up my optimism about the economy navigating through. It's going to, the shape of the yield curve at the very least is strongly arguing that growth is going to slow very dramatically here. And if it stays as inverted as it is, it will start, in my view, signal a recession. So hopefully that doesn't continue in the trading days ahead.
Mark, the president called the numbers, the CPI number, unacceptably high, but also out of date based on the fact that gas prices have begun to come down for several straight weeks. Are you willing to proclaim that inflation has finally peaked? And apologies for the double. Are we headed for a 100 basis point hike?
Yeah, well, I say with great intrepidation, but I think the president is right. Gasoline, oil prices are way down from where they were last month. Gas, diesel, jet fuel prices are coming in. That's really critical. That's the first step in getting inflation down. And it feels like we are now taking that first step. And if you ask me back a month from now, and we have this conversation around the July CPI report, it's going to look a lot better than the June report. So I think that's right. I mean, I'm hesitating because there's so many uncertainties, unknowns around what's going to happen with Russia and Ukraine and EU sanctions and what are the Saudis going to do. And, it's not even just oil, it's refining capacity, right? We have no refining capacity. So if a Cat 5 hurricane blows through the Gulf, hits the Texas coast and takes out a refinery for a few weeks, we got a problem. So, we're really on an edge here. But I think, it's fair to say that, we've seen the peak and we're moving in the right direction. On the 100 basis point hike, in my view, I think the Fed should do whatever the market says they should do. So if the market says, hey, I think you're going to raise rates 100 basis points, I would take that opportunity to raise 100 bips because markets should then not react to that, right? I mean, it's already embedded in equity prices and credit spreads and the value of the dollar and the mortgage rate. So, and we all know that they have to get rates up, as fast as possible. But if the market is saying 75 basis points, 3/4 of a point, I'd go with that. I mean, that's good enough. You're getting rates up fast enough. So it's really about what market expectations are at this point. And that, I think, will determine whether it's 100 basis points or 75.
Mark, if we do get that 100 basis point hike at the end of the month, what does that mean then for the fall in September? Will we see the Fed quickly start to scale back?
Yeah, I mean, I think with these rate hikes, we're going to see much slower growth. Job growth is going to slow meaningfully here, and other indicators are going to show the economy is really starting to throttle back. And hopefully I'm right about inflation, and we'll see inflation moving in the right direction here. And the combination of those things, two things will allow the Fed, they'll continue to raise rates, but at a much slower pace. So instead of 75, 100 basis points, it'll be 25 basis points, maybe 50. And then they'll get the funds rate target up to, they're now targeting something between 3.5% and 4%. And that sounds about right to me. I think that feels like where they're headed. Just a question of when we get there. At the very latest, it will be this time next year. But I do think, growth will slow, inflation will moderate, and that'll allow the Fed to keep stepping on the brakes, but maybe not quite as hard as they're doing right now.
All right, got to leave it there. Moody's Analytics Chief Economist, Mark Zandi. Good to see you, sir. Thanks.